Rich Dad, Poor Dad. Breaking down the book that sold 40 million copies. 40 million copies sold. Translated into 51 languages. 8 consecutive years on the New York Times bestseller list. A record that still stands today. But ask a random person who's read this book what the method actually is, and most will give you something vague. Something about assets and liabilities and not working for money. Today, we're breaking down the book itself, the 6 specific lessons Kiyosaki built the whole thing around, the real numbers and stories he uses as proof, and, most interestingly, why this exact book, out of dozens of similar titles, became a phenomenon read in literally every country on Earth. By the end of this video, you'll know exactly what's actually written in this book, not just the vague, secondhand impression most people carry around from summaries online. The story that kicks everything off. The book doesn't open with abstract theory. It opens with a specific story from Kiyosaki's childhood. At age 9, he and his best friend Mike, who got teased for their families not having money, decided to literally make money. They collected used toothpaste tubes, melted down the metal, and tried to cast coins out of it. Kiyosaki's father caught them in the act, explained that counterfeiting money was illegal, and instead of punishing them, suggested they go get real advice from Mike's father, a successful local businessman. That's the moment their years-long apprenticeship under Rich Dad begins, and the very first practical assignment wasn't any kind of payment at all. It was working literally for free. Rich Dad had the 9-year-olds work in his store for 10 cents an hour, and when they complained about the low pay, he deliberately refused to raise it, forcing them to come up with their own way to earn more, forcing their brains to work instead of just waiting for a raise from the boss. The result of that lesson was that the boys came up with their first real business. They started taking used comic books from a local store owner for free, kept them, and opened a paid comic book library for neighborhood kids, barely working themselves, hiring Kiyosaki's younger sister to run the library for a small fee. By Kiyosaki's own account, this was the first real-life illustration, in his life, of the principle that would become central to the entire book. Money should work for you, not the other way around. We've covered where the book's origin story comes from. Now let's get into the actual structure, the 6 specific lessons the entire book is built around. Lesson 1. The rich don't work for money. The first, and arguably most provocative, lesson goes like this. The poor and the middle class work for money, while the rich make money work for them. Kiyosaki describes this as a fundamental mindset trap. Most people, driven by fear of running out of money, go to work, get paid, feel temporary relief, and then start fearing scarcity again, which pushes them to work even harder. The book calls this closed loop the rat race, a direct comparison to a hamster wheel, where you can run forever without actually going anywhere. The core point of this lesson isn't that working is pointless. It's that money earned through labor should be directed not toward consumption, but toward acquiring assets that then start generating income on their own, without requiring additional work. We've covered the first lesson about mindset, but for that mindset to actually work in practice, a person needs a concrete decision-making tool, which brings us to the second and most frequently quoted lesson in the book. Lesson 2. Why financial literacy matters. Assets versus liabilities. This is, without a doubt, the most famous idea in the entire book and the one most often quoted in summaries. Kiyosaki gives an extremely simple, unconventional definition. An asset is something that puts money in your pocket, and a liability is something that takes money out of your pocket, regardless of how that thing looks from the outside or what society says about it. The most provocative application of this definition concerns your own home. Kiyosaki states directly that the house you live in is not an asset. It's a liability because it doesn't generate income for you. Instead, it costs you money constantly through mortgage payments, property taxes, and upkeep. That claim caused and still causes the most debate among professional financial advisors, because for most people, their home remains the single largest personal savings vehicle and a long-term store of wealth through property appreciation. By Kiyosaki's classification, real assets include businesses that don't require your personal presence to run, stocks, bonds, mutual funds, real estate that generates rental income, promissory notes, royalties from intellectual property like patents or music, and any item of value that either generates income or appreciates over time. We've covered what counts as an asset according to the book. But understanding the theory is one thing. Seeing the specific numbers Kiyosaki offers as proof this principle actually works in practice is another. A real example with numbers from the book. Kiyosaki describes his own strategy for buying income-producing real estate and how he turned the profit from one deal into capital for the next. By his own account, starting with a relatively modest sum, he ran through 7 such deals in sequence, reinvesting the profit from each one into the next property, and ended up with a real estate portfolio worth roughly $190,000, generating about $19,000 a year in income from interest and rent. An important caveat worth adding here, which Kiyosaki himself barely mentions in the book. These figures date to the late 1980s and early 1990s, well before the book's publication in 1997, and adjusting for inflation and how much market conditions have changed, it's extremely difficult for today's reader to literally replicate that exact sequence of deals. This is exactly one of the points where critics of the book flag the gap between the inspiring narrative and the practical applicability of the specific numbers in today's market. We've covered a concrete, numerical example. Now let's move to the book's third lesson, what Kiyosaki calls the main reason people, even while earning a lot, stay stuck without real wealth. Lesson 3. Mind your own business. The third lesson sounds paradoxical at first. Kiyosaki argues that an enormous number of people spend their entire careers minding someone else's business, meaning working for a company and enriching that company's owners, instead of simultaneously building their own assets. He draws a clear line between a person's profession, meaning what they do to earn a living, and their actual business, meaning their column of assets, which exists independently of their day job. The practical advice that follows from this lesson: even while employed, it's important to direct part of your income each month not toward current consumption, but toward buying or building assets, whether that's a small stock position, a stake in a startup, or a piece of real estate, gradually building a parallel structure that can eventually replace income from your main job. We've covered the idea of your own business, but the next lesson is the most controversial and the least obvious to an ordinary reader, because it touches on a topic most personal finance books don't cover at all. Lesson 4. The history of taxes and the power of corporations. In the fourth lesson, Kiyosaki moves into a topic that, for many readers, was a genuine revelation: the difference in taxation between an ordinary employee and the owner of a registered business. He explains that an employee pays taxes on income before they even get the chance to spend that money on anything, while the owner of a corporation spends money on legitimate business expenses first and only pays tax on whatever's left over. This section of the book drew a separate wave of criticism from professional accountants and tax advisors, who pointed out that real-world tax law is far more complex than the simplified scheme in the book, varies enormously from country to country, and requires professional consultation rather than simply copying the general idea from a popular finance book written more than 25 years ago. We've covered the tax side of things, but the fifth lesson brings us back to a broader philosophy, what Kiyosaki calls the skill of seeing opportunities where other people only see problems. Lesson 5. The rich invent money. The fifth lesson centers on the idea that wealth is created less through accumulating money and more through the ability to recognize and create financial opportunities that most people simply don't notice. Kiyosaki tells several of his own stories here, including buying a real estate investing course for $385 with almost no money to spare at the time, a sum he could barely afford at that point in his life, and claims the skills from that course went on to earn him millions of dollars through a series of real estate deals. The core message of this section is that financial education itself is an asset, one that pays for itself many times over. but only if a person actually applies what they've learned in practice, rather than simply accumulating theory. We've covered the fifth lesson about opportunity. That leaves one final, sixth lesson, and many readers say it's the one that applies most directly to an ordinary, everyday career, not just the world of investing. Lesson 6. Work to learn, not to earn. The final of the six main lessons advises readers, when choosing a job, to focus not just on salary, but on what specific skills that position will let them build. Above all, sales, marketing, management, and understanding cash flow, regardless of industry. Kiyosaki describes deliberately choosing a sales job at Xerox, specifically to overcome his own personal shyness and learn how to sell, understanding that skill would become the foundation for any future business he'd ever build. The idea is to treat the early years of your career not as a source of immediate financial payoff, but as an investment in your own skill set, one that pays off later once you start applying those same skills to your own projects instead of someone else's company. We've covered all six of the book's core lessons. Now, to a question that's actually more interesting than the content itself. Why this specific book, out of hundreds of similar personal finance titles, became an absolute sales phenomenon? Why this exact book became a phenomenon? The first reason is the format. Unlike most finance books, written in dry language full of tables and formulas, Kiyosaki structured this one as a personal story and a parable, as far from a textbook as possible. That simplicity of language made the book accessible to people with no economics background whatsoever, meaning the vast majority of readers for whom typical investing books felt too complicated or too boring. The second reason is how it spread. The book was initially self-published, with no major publisher behind it, and for the first few years it spread largely by word of mouth, through Kiyosaki's connections to a multi-level marketing network, where he was already known at the time as a lecturer and the author of training programs that created organic, grassroots growth and popularity long before big media outlets ever took notice. The third reason is the moment that finally turned the book into a global bestseller: Kiyosaki's appearance on Oprah Winfrey's enormously popular talk show in the year 2000. That single appearance put the book and its ideas in front of tens of millions of people at once and sent it straight onto the New York Times bestseller list, where it went on to stay for a record 8 consecutive years. The fourth reason is the universality of the message. The idea that financial success can be learned rather than inherited, and that nobody teaches it in school, resonated with people across every income level and in literally every country on Earth, which explains the translations into more than 50 languages and sales that have continued for nearly 30 years running. A quick word on the criticism. It's worth mentioning honestly and briefly. Despite its enormous commercial success, the book's content has faced serious criticism for decades from professional financial advisors over the oversimplification of specific advice, the lack of verifiable sources behind many of its stories, and potentially risky recommendations around using borrowed money for readers without real experience. That said, it's impossible to separate the book's content from the effect it's had on the financial literacy of millions of people worldwide, and that's exactly why it remains a source of so much debate and so much praise at the same time, nearly 3 decades after it was first published. Conclusion. If you had to boil the entire book down to one idea, it would be this: the difference between the rich and everyone else isn't luck or salary size. It's where the money you earn actually goes and how much time you invest in your own financial education. The book's 6 lessons, from the comic book library story at age 9 to the differences in how corporations are taxed, are all built around one central idea: make your money work for you, instead of spending your life working for money. Whether you agree with every single piece of advice in this book or not, the sheer fact that a simple book, written in plain language, changed how tens of millions of people around the world think about money makes it one of the most significant phenomena in the history of personal finance literature. If this was useful, subscribe. More breakdowns of books and stories that genuinely shaped how people think about money are coming next. This channel is for educational purposes only. We share research and biographical information, not financial advice. We are not responsible for any decisions made based on this content.